Hi, welcome to this Thursday talk on quant investing. This month, as you know, the topic is quant investing. We've already done two videos on quant investing where we've taken you through the differences in terms of the type of investing approaches like empirical, theoretical, theory-driven, or data-driven. We've looked at what most people think quant investing is well, not all the also the fact that not all models are the same. All quant investing is not high frequency trading, etc., etc. So uh, and uh, and broadly, what is investing, and is it more science? Is it more art? We spoke a little bit about that last time, and uh, and then we introduced you to what is a factor when it comes to quant. That is the basic building block of quant investing, which is viewing portfolios or stocks through the lens of a factor. And we took an example of an investor, say RJ, and the simple relationship between the appearances by RJ on television and the expected return of the stock. Of course, this was just a completely made up example, and we spoke about that. So if you want to look at just understand all this, you can look at our previous two videos. And with that, we'll go into today's video. So today we're going to talk about a little bit of the history of factor investing and how it came about. And it may surprise you to know that perhaps some of the earliest value investors like Ben Graham, Dodd, were actually fairly quantitative in their approach when it came to picking stocks or building portfolios. For example, Graham had a set of rules that he's also laid out in the Intelligent Investor and his other book, Security Analysis, where he looked at certain ratios to pick stocks and to build a portfolio of those stocks. Then in the 50s came Harry Markowitz, which is modern portfolio theory, the efficient frontier. And then it was around in the 60s that the first model of how to price equities came about in the form of the capital asset pricing model, or CAPM, uh, given by Bill Sharp. Then we had a sort of, you know, we did have people writing about momentum, low volatility value, the size premium, and all of that. But it was not until the 1990s when Fama and French expanded the CAPM to include two other factors, namely the value and the moment, value and the size factor. And the next year, when Jagdish and Titman wrote their paper on momentum, mind you, in their paper, the word momentum has not been mentioned even once. And then in 1997, Mark Carhart wrote his paper on, he was looking at mutual funds and whether there was any alpha in mutual funds. And then he stumbled upon that incidentally outperforming managers tend to hold momentum stocks. And then now we've got, a couple of more factors, which Fama and French have also added. Novi Marx has added profitability, and Fama and French have added accruals as well as profitability to their factor model, which is now a five-factor model. They still don't have momentum in their formal academic model, but they do use it in practice in their firm dimensional advisors. With that, let's just look at how portfolio evaluation has evolved over the ages. Now, in the 60s, if you looked at portfolio return, the entire thing would be attributed to say taking equity risk because you've invested in equity over say debt or gold or some other asset class like real estate. The entire return on that portfolio would be saying that you're taking equity risk, irrespective of whether which stock you bought or whether you bought a mutual fund or whether you index funds are not available in the 60s, but whether you sort of bought a diversified portfolio of stocks. Then in the 1980s, when the CAPM model became sufficiently established. What we understood how to measure what are the returns of a broadly uh, diversified market index, and any return over that market return was called alpha, or what could be attributed to a fund manager's skill. Uh, and then in the 2000s, once the papers and the models proposed by Fama French, Carhart, Jagdish Tickman, uh, and a whole host of other academics, including some practitioners like Cliff Asness, who did his PhD under Eugene Fama, and in fact wrote a paper on momentum while Fama was his PhD thesis guide. So in the 2000s now, we broadly understand that alpha is not just the return over the broad market return, but it can also uh, has to account for exposure to certain styles of investing, like say value investing, uh, investing in small caps over large caps, investing in quality stocks, or investing in momentum stocks, or having a moment or following a momentum strategy, the way whichever way you put it. So this can be attributed to a portfolio manager, not to the stock picking ability of the portfolio manager, but to the fact that they have built a portfolio which has exposure to these assets. Now, uh, only and above, if you have declare, harvested returns, or you have been able to produce returns which can be shown to be over and above the market return, which is now called passive investing, over and above factor returns, which are uh, now easily measurable. That is now attributed to alpha. So now the alpha has considerably shrunk from what it used to be in the early. It's not that the alpha has shrunk. It's now we've understood the sources of returns in much greater detail, and we know we are able to replicate such returns with a portfolio of say value stocks or momentum stocks or quality stocks much more easily. We can explain that this manager perhaps made more money because he or she was tilted towards value stocks in a period when value stocks did well, or he or she was tilted towards momentum stocks in a period when momentum did well. So, and now these portfolios are available in a form of a mutual fund or an ETF. So you cannot say that that is alpha. That is the return due to factor exposure. And only and above that, if you're generating something, then you can say that okay, and that is also after a very very long period, track record, that one can say that there was alpha in those in that portfolio management return. Now let's look at you know I spoke a little bit about this when we went through the timeline of factor investing and development. So during the 1980s, CAPM was ruling, and what the CAPM proposed that every stock, which we saw in our basic example that I showed you in our second video, that every stock or portfolio has some level of sensitivity or covariance, that it moves alongside with the broad market, because it is at the end of the day an equity asset, belongs to the equity asset class. So that covariance or co-movement is also called beta, and is a measure. It can also be taken as a measure of volatility. For example, if the beta of a stock is 1.2, the market beta is always 1. So if the stock beta is 1.2, then it is if the market moves 10%, it is expected that that stock will move up by 12%. Similarly, on the downside, if the market falls by 10%, it is expected that the stock will also fall by 12% and not 10%, because it is more sensitive to stock to the market fall when it falls as well as when it rises. Now, this factor or beta is commonly now referred to as the market factor, or what we get in the form of index fund, broad market index fund. Now, in the 1990s, as I explained, Fama and French added two more factors, value and size, where they said there's a value premium for buying stocks that are undervalued over stocks that are overvalued, commonly called growth also in factor investing parlance. And also the fact that there was a premium for taking on buying stocks that are of companies that are smaller in size in terms of market capitalization over buying large cap companies, because there is some risk attached to buying small, mid and small cap companies, which may not be as established as large cap companies. This has is a bit contentious now, and this size premium is thought to have shrunk quite a bit, and there is quite a debate around it. What is the most contentious factor actually is momentum, and incidentally, in India as well as globally, momentum is one of the most strongest and the most pervasive factors, which is persistent. It is pervasive because it's present across asset classes, it's robust, it works across the ages, but somehow, because it also comes with higher churn, it's sort of viewed as that no, this is not investing. Investing is, we have this thing in our mind that investing is supposed to be just buy and hold or buy and low churn or something like that sort. You can be an investor in a particular style or strategy also. You don't have to just be an investor in a stock. A lot of old school people may not agree with that, but having seen both sides of the investing spectrum, I would say that I hope that people view this with more open mind and accept the fact that even they make money only when there is momentum in their stock, not just by virtue of picking a stock and thinking that it's gone up because of the superior analysis of some of that. So, that's more or less on the history of the factor model and factor investing. And it's important to understand this timelines and this evolution. And next week we'll look at some of these factors in more detail and see how to now map the returns of your favorite manager, whether it's a mutual fund manager or uh, it's easier to get details on or data on mutual fund manager. So we'll probably pick up a mutual fund and run a regression or an exposure analysis on that mutual fund and see what is that mutual fund actually delivering to you. With that, we come to an end on today's video with the usual disclaimer that this is not investment advice. It's only for educational purposes. And please consult your investment advisor before investing. And you can follow me on Anish Daily on Twitter at QEDCAP. We are proofing up our website. We're adding more stuff to it. So maybe the next couple of weeks we'll come to you with an update on that. And like, subscribe, and follow our YouTube channel. And if you have any more questions on factor investing, quant investing, or investing in general, feel free to just drop a comment or shoot us an email, and we'll be happy to reply to you. Thanks a lot, and have a good weekend, a long weekend, and happy Diwali to everyone. See you again next week.